Picture this. Two investors, same starting point, completely different outcomes. Investor A bought Apple stock in 2003 for $1,000, and today that investment is worth over $1.1 million. Investor B put that same $1,000 into the S&P 500 in 2003, and it's worth about $10,000 today. So Apple absolutely crushed it, right? But here's the plot twist that's going to blow your mind. By the end of this video, you'll discover which strategy actually creates more millionaires, and it might completely shock you. I'm going to show you the real data, the hidden costs, and the psychological traps that separate successful investors from those who struggle. If you find this helpful, don't forget to hit that like button and subscribe for more smart investing insights. Let me tell you about two friends who started their investing journey at the exact same time. Meet Sarah, the ETF investor, and Mike, the individual stock picker. Both of them had $10,000 to invest in early 2020, right before one of the most volatile periods in market history. Sarah decided to keep it simple and put her money into a broad market ETF. Mike, on the other hand, was convinced he could beat the market by picking individual stocks. He spent hours researching companies, reading financial reports, and following market news. Over the next few years, they both watched their portfolios go through the COVID crash, the recovery, inflation fears, and everything in between. Their final results are going to reveal some uncomfortable truths about which approach actually builds lasting wealth. But first, let me give you the complete framework I use to analyze this decision. I've spent years studying investment data, and I'm not just going to tell you what to buy. I'm going to teach you how to think about this decision so you can make the right choice for your specific situation forever. Now let's dive deep into the world of ETFs, and I want you to imagine something for a second. Picture yourself at a casino, but instead of betting on just one number on the roulette wheel, you're betting on every single number except maybe the 5 worst ones. That's essentially what an ETF does for your investment portfolio. When you buy shares of an ETF, you're not just buying one company. You're buying a tiny piece of hundreds or even thousands of companies all at once. Here's a real example that perfectly illustrates this power. The S&P 500 ETF holds 503 different companies. In 2022, Netflix had an absolutely brutal year, crashing 62.5% and becoming the worst performing stock in the entire S&P 500. If you had owned Netflix as your only stock, you would have lost over half your money in a single year. But if you owned the S&P 500 ETF, you barely felt Netflix's crash because it was just one holding among hundreds of other companies. While Netflix was imploding, other companies in the ETF were doing well, and the diversification protected you from catastrophic losses. The beauty of ETFs goes way beyond just diversification, though. Think about your daily life for a moment. You're building a career, maybe raising a family, pursuing hobbies, maintaining relationships, basically living a full life. Do you really have time to analyze quarterly earnings reports, track CEO scandals, monitor competitive threats, and constantly research new investment opportunities? For most people, the honest answer is absolutely not. This is where ETFs become like having a professional portfolio manager who never sleeps, never takes a vacation, and constantly rebalances your portfolio without you having to do anything. When companies start performing poorly and dragging down the index, they automatically get kicked out and replaced with better performing companies. You don't have to make any decisions, do any research, or even think about it. The ETF handles all the heavy lifting while you focus on living your life. But let's be completely honest about the dark side of ETFs, because there are real downsides you need to understand. I once met an investor who thought he was being incredibly smart by owning 15 different ETFs. He had a technology ETF, a healthcare ETF, an international ETF, a small cap ETF, and the list went on and on. He thought he was diversified, but he was actually just paying multiple management fees for essentially the same exposure to the stock market. This is called over-diversification, and it's surprisingly common. Another reality check is fees. That 0.03% expense ratio sounds absolutely tiny, but fees compound just like your investments do. Over decades of investing, even small fees can cost you significant wealth because you're not just losing the fee amount, you're losing all the compound growth that money could have generated. Now let's flip the coin and explore the wild world of individual stock investing, where the potential for life-changing wealth is absolutely real, But so are the risks that can wipe out your entire portfolio. The numbers here are going to make your jaw drop. If you had invested $1,000 in Amazon when it went public in 1997, that investment would be worth $1.34 million today. That's a 134,000% gain, the kind of return that can literally change your family's financial future forever. Or consider Nvidia, which gained 239% in 2023 alone. No ETF on the planet comes close to that kind of single-year performance. Then there's Apple, where $1,000 invested in 2003 grew to over $1.1 million. These aren't fairy tales or get-rich-quick schemes. These are real companies that created real wealth for investors who had the courage and insight to buy and hold their shares through all the ups and downs. Individual stock investing also gives you something that ETFs simply cannot provide: complete control and customization. Maybe you care deeply about environmental issues and don't want any oil companies in your portfolio. With individual stocks, you can build a portfolio that perfectly aligns with your values. Maybe you have strong convictions about certain industries, or you've done deep research on specific companies that you believe are undervalued. Individual stocks let you act on those convictions and potentially profit from your insights. Plus, there are zero fund management fees eating away at your returns year after year. Every single dollar you invest goes directly to work for you, not to pay some fund manager's salary. But here's where we need to have a brutally honest conversation about the reality of individual stock investing, because the statistics are sobering and most people don't want to hear them. According to Dalbar's comprehensive 30-year study of investor behavior, the average individual investor earned 6.81% annually, while the S&P 500 returned 9.62% over the same period. That's a 2.81% annual underperformance, which might not sound like much until you realize it means $1 million less wealth over 30 years on a $100,000 investment. The data is crystal clear. The vast majority of individual investors do not beat the market, even before accounting for the time and stress involved. Speaking of time, successful stock picking isn't a casual hobby. It's essentially a part-time job. You need to spend at least 10 to 15 hours per week minimum reading financial statements, analyzing competitive positioning, tracking earnings reports, monitoring industry trends, and staying on top of news that could affect your holdings. You need to understand accounting principles, valuation methods, business strategy, and economic indicators. Most people drastically underestimate the time commitment required to do this properly. And when they try to do it casually, they make expensive mistakes. Then there's the emotional component, which might be the biggest killer of all. During March 2020, when the market crashed due to COVID fears, the average investor did exactly the wrong thing at exactly the wrong time. They sold their stocks at the bottom when everything looked hopeless, then bought back in near the top when they felt confident again. This emotional whiplash turned what should have been a temporary 30% drop into permanent losses for millions of investors. Watching your individual stock holdings swing wildly in value every day creates an emotional roller coaster that most people simply cannot handle rationally. Now, I want to share some research that's going to completely change how you think about this entire debate. The Dalbar study I mentioned earlier is the most comprehensive analysis of investor behavior ever conducted, covering 30 years of real investor returns versus market performance. The results are shocking and definitive. The average individual investor achieved 6.81% annual returns, while simply buying and holding an S&P 500 index fund would have delivered 9.62% annually. That 2.81% difference doesn't sound like much, but compound interest makes it devastating over time. On a $100,000 investment, that performance gap results in over $1 million less wealth after 30 years. Think about that for a moment. By trying to be smart and beat the market, the average investor actually made themselves significantly poorer than if they had just done nothing and bought a simple index fund. Let me bring this back to our two friends, Sarah and Mike, and reveal what actually happened to them. Sarah, the ETF investor, took a completely hands-off approach. She set up automatic investments into a broad market ETF and basically forgot about it. She spent maybe 2 hours total managing her investments over the entire period. Mike, the individual stock picker, spent over 200 hours researching companies, reading financial reports, and constantly tweaking his portfolio. He felt smart and engaged and in control of his financial destiny. But here's the reality check. Mike's portfolio underperformed Sarah's by about 3% annually. Sarah thought she was being lazy and taking the easy way out. Mike thought he was being intelligent and proactive. The data shows exactly who was actually right, and it might not be who you think. So how do you decide which path is right for you? Let me give you a simple framework to think about this decision. If you want to build wealth while actually living your life, if you don't want investing to become a second job, if you value simplicity and proven results over the excitement of stock picking, then you're an ETF warrior. This approach is perfect for people who understand that boring often beats exciting when it comes to building long-term wealth. On the other hand, if you genuinely love research and analysis, if you have significant time to dedicate to studying companies and markets, if you can handle high levels of volatility without making emotional decisions, and if you understand that you're statistically likely to underperform the market, then you might be cut out for individual stock investing. But here's what I actually recommend for most people, and it's the approach I use in my own portfolio, a hybrid strategy that gives you the best of both worlds. I keep 85% of my money in low-cost ETFs as my foundation. This gives me broad market exposure, automatic diversification, and steady long-term growth without any effort on my part. Then I allocate 15% to individual stocks that I've researched thoroughly and believe in strongly. This lets me scratch the itch of stock picking and potentially capture some outsized gains, but it prevents any single stock from destroying my overall portfolio. My rule is simple. Never put more than 5% of my total portfolio in any single stock, no matter how convinced I am that it's going to be the next Amazon or Apple. Here's the million-dollar truth that most people don't want to accept. The real question isn't which approach can theoretically make you richer. Both ETFs and individual stocks have created plenty of millionaires over the years. The real question is which approach you'll actually stick with for 20 to 30 years without sabotaging yourself through emotional decisions, overtrading, or abandoning your strategy during inevitable market downturns. The data overwhelmingly shows that consistency and patience matter far more than trying to be clever or timing the market perfectly. The investment industry wants to make this decision seem complicated because complexity sells products and generates fees. But the truth is elegantly simple. For the vast majority of people, a portfolio of low-cost ETFs will deliver better risk-adjusted returns with far less stress and time commitment than trying to pick individual stocks. That doesn't mean individual stock investing is wrong. It just means you need to be brutally honest about your skills, time availability, and emotional temperament before you go down that path. So here's what I want you to do right now. Drop a comment below and tell me, are you Team ETF or Team Individual Stocks, and why? I read every single comment, and I love hearing about your investing philosophy and experiences. Make sure you hit that like and subscribe button because I'm revealing the complete strategy in next week's video, including the specific funds I use and the exact percentages I recommend. Remember this above all else. The best investment strategy is the one you'll actually follow consistently for decades without abandoning it during tough times. The data is crystal clear about what works and what doesn't. Choose the approach that fits your personality and lifestyle. Invest regularly regardless of what the market is doing, and let compound interest work its magic over time. That's how real wealth gets built, and that's how you win the long-term investing game. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.